Welcome to the fifth lecture of the model series. During this lecture, we're going to discuss additions. If you did not watch the previous lectures yet, I would highly advise you to do so first, because this lecture is going to build upon the knowledge shared within those lectures. During this lecture, we're going to look at ways to fine-tune our current model and how we can add extra confluences into our series of requirements. Before we can begin with today's lecture, I must first give you a risk disclaimer. I, or TOTK, am not a financial advisor. I will share my own opinions about the marketplace. I will share my own experience with you. This is not meant for financial advice. The reason why I'm sharing this is purely meant for educational and or entertainment purposes only. If you want to read the full risk disclaimers that you agreed upon when signing up to the mentorship or to TOTK, you can do so on theonesthatknow.com. So before we can add extra additions to our current model, we will first take a look at the market maker buy model schematic. It's a rather simple schematic where we can see a green box up here, which represents an original consolidation, an area where buy side liquidity has been engineered above the highs, followed by sell side delivery lower into our point of interest during our time of interest. This yellow box represents the smart money reversal, the SMR, and from there on we see buy side delivery targeting the original consolidation's high. We're going to build up on this schematic, and during the beginning part of this lecture, we're going to focus on this yellow box, which represents the smart money reversal. We're going to take a close look at the reversal, and we are going to see what always occurs in every reversal besides the creation of a breaker or mitigation block, because there's something else, and that is so crucial when it comes to determining whether or not a reversal is in place. So let us take a look at that. What we're going to take a look at is intermarket relationship. Within a market maker buy model, we can look for a cracking correlation between correlated assets, correlated markets, on the lows if our point of interest has been reached during our time of interest. Because you need to understand that highly correlated markets should always behave in the same manner. That means that when one creates for example, a lower low, the other one should also create a lower low. If we are taking a look at the following schematics, where we can see the ES, Nasdaq, and Dow Jones chart, and we take a close look at what is occurring at the lows within a market maker buy model, we can see that ES makes lower lows, Nasdaq makes higher lows, and the Dow Jones makes lower lows, all whilst trading into that yellow box, which is our smart money reversal within that market maker buy model schematic. What we can see is that there's a cracking correlation between ES slash Dow Jones and the Nasdaq, because both ES as the Dow Jones made lower lows, whilst the Nasdaq makes higher lows. And this SMT is so crucial because it's a confirmation of a smart money reversal occurring at your point of interest during your time of interest. And every single reversal will have this. And you might be thinking, how could every single reversal have this SMT? Because until SMT is present, the market is not allowed to reverse. And the SMT can be with a very wide amount of markets. So for example, if we are looking at the SMT can occur with Nasdaq, the Dow Jones, or even with the dollar index. Same for Nasdaq, same for Dow Jones. So if you are able to have multiple charts open at the same time, if you have an extra monitor for that, an extra screen, I would highly advise you to have a tab open with all these markets that are of interest to you, because the moment that price reaches your point of interest during your time of interest, the moment begins that you will actively look for a Kraken correlation to form. Because after this Kraken correlation has formed and you see change in the state of delivery occur, it's the most beautiful sign that, okay, we're now likely to expand to the upside, if bullish. If you're looking at, for example, other markets than ES, Nasdaq, or Dow Jones, so you're, for example, looking at the EU or GU, what you then do is that you compare EU, Euro USD, to the GBP USD. And that's how you can basically use all correlated markets to see whether or not SMTs are present. Here we can see the SMT on the lows annotated. ES makes a lower low, Nasdaq makes a higher low, Dow Jones makes a lower low. Notice what is being signaled right here. Oftentimes you will see that the market that creates a higher low whilst the others make lower lows already traded into its respective point of interest or its respective range low before the other markets did. And therefore it's a matter of time for the other markets to also trade into their point of interest during the time of interest before the markets are allowed to reverse. It's time and price meeting. If you are taking a look at inversely correlated assets for SMT within a market maker buy model, we can see the following. The market maker buy model is taking place on euro, so foreign currencies. And what we can see is that Dixie trades into its respective point of interest during a time of interest. And euro trades into its respective point of interest during its time of interest as well. Dixie does the opposite of euro. So when Dixie trades into a premium of the range, whilst euro trades into a discount of the range, and we are anticipating euro to continue higher, to draw higher, what we will be looking for then is for an SMT to form between EU and the DOR index. And the SMT will be in the following form, where we will see the DOR index make a higher high, whilst the euro makes a higher low. And within that bullish thesis, this is the sign that the SMR smart money reversal is in, and from there on we can anticipate that the foreign currencies are likely to be allowed to expand higher. The reason why this is occurring is again because the moment that the SMT takes place, the markets are allowed to expand. They are allowed to reverse. The SMT is present here. We can see higher highs get formed on the DOR index and higher lows on the euro. Let us now take a look at the market maker sell model. This occurs within higher time frame bearish order flow. What we can see is that there's a green box which represents the original consolidation. Below that green box, sell side liquidity gets engineered. The market expands higher into our point of interest during our time of interest. And from there on, we see that a smart money reversal forms, and this yellow box represents that. We're going to zoom in on this smart money reversal again. For correlated markets, an SMT looks like the following. A Kraken correlation within a market maker sell model. What we see is that ES trades into its respective point of interest, creates a high, followed by a lower high. Nasdaq creates a high, followed by a higher high. And the Dow Jones creates a high, followed by a higher high. And what we can see is the following. We can see that ES did something different on the highs relative to Nasdaq and the Dow Jones. And the reason why this is significant is because we already established that the market reached our point of interest, our, so to say, point of interest for a reversal to originate from during our time of interest. And to then see SMT, a cracking correlation between these higher correlated markets, is a confirmation of our thesis likely to play out. And the moment that we see CSD occur, this is the ultimate confirmation of that being the case. Again, this occurs within bearish higher time frame institutional order flow. This is where we can see the SMTs, the cracking correlations highlighted. We can see that ES makes a lower high, whilst Nasdaq makes a higher high, and the Dow Jones makes a higher high as well. If we take a look at inversely correlated markets, their SMT within a market maker sell model, so a sell model occurring on the EU, we can see the following. We can see that Dixie trades lower into a point of interest during a time of interest, and a higher low gets formed. Whilst this is occurring, Euro trades into its respective point of interest during a time of interest, and a higher high gets formed. This higher high creation, whilst dollar makes a higher low, is a sign of weakness on Euro, and it is a sign of strength on the dollar. The change in state of delivery, the displacement leg lower, confirms this. Here we can see the SMT outlined, where the dollar creates a higher low, whilst Euro creates a higher high. We're now going to take a look at the next topic of this lecture, the next edition, so to say. This topic is going to be about feeling order flow. And you might be wondering, what does feeling order flow mean? Well, feeling order flow is the following. Feeling or gauging order flow means knowing when price will expand, retrace, expand or consolidate, etc. after you have established that a smart money reversal is in. Simply said, feeling order flow is basically having a nudge for what price is likely to do next now that you're in a position, or now that price has showed a willingness to reverse. This is important for trade management, so pay attention. Feeling the order flow comes whilst focusing on how price delivers after you have established a smart money reversal being in. Once you know how to feel order flow, managing positions is an objective and straightforward process. However, getting a feeling of order flow sounds way easier than it actually is. We're first going to take a look at the general schematic which you can utilize to gauge the order flow within a buy program. And after that, I will take you into some live executions and share how I view the order flow whilst price is printing. Let us first take a look at a rather simple schematic of a market maker buy model. Notice that we're all basing our foundational knowledge on the schematics that we begin with during the first lecture of the model series. Because if we understand that there's an original consolidation, there's sell side delivery into a price level where the market will likely reverse from if it reaches it during the right time period, our time of interest, and we then see a smart money reversal form and buy program unfolds, we can strip it down all the way basically to an arrow lower, arrow higher. But in reality, that is not how the market prints, because there will be retracements, of course. However, I am just sharing with you the importance of keeping your understanding of price very simple. And you might be thinking, very simple? How could that make me profitable? How could that help me? Well, you need to understand that in order to become profitable and to gain an edge, so to say, you must be able to execute a very simple rule-based protocol. However, if you combine that with advanced knowledge, meaning that you understand the basics to an advanced level and that you can add things to the basics that the masses don't see, you will be unstoppable and you will see things that so many people do not see because they're too focused on things that do not matter. You need to understand what's important and then pay close attention to the details because that's where the growth takes place. It's not by simply adding new stuff, the next trend, whatever might be popping off on social media. You simply focus on what works and you stick to that and you improve upon that knowledge because this is how the market moves, if bullish. You can argue with me all you want, but I know that this is the case and I want you to try and prove me wrong. And if you go into your charts, you will figure out that that is not possible. But let us take a look at this schematic now. As you can see sell side delivery occur into our smart money reversal. I must say into our point of interest where smart money reversal forms. The sell side delivery occurs through the following manner. Expansion away from the origin, consolidation, retracement, expansion, retracement, expansion, retracement, expansion, followed by a reversal, displacement higher. This is an expansion leg. Retrace, expand, retrace, expand, retrace, expand. This is of course a dream scenario where it moves so quick, and usually within a real environment you will see that there will be consolidations throughout the market maker model, and this is time distortion because logically speaking and theoretically speaking, this is how the market moves from point A, which is a smart money reversal, to point B, which is the high of the original consolidation. If we take a look at a more advanced schematic, utilizing the same foundation, but just added a few things, there are some general rules that I want to share with you that are probably not known to you thus far. First of all, we're going to take a look at the following, where we are measuring premium to discount of the range from the original consolidation's high to the low of the smart money reversal. If we have premium and discount established, premium being above 50% of that range and discount being below 50% of that range, we can note the following. And these are important rules to understand. Whenever price displaces above 50% of the range, above equilibrium, we are anticipating the market to draw towards the opposite side of the range. So a common question that I get asked a lot is the following, even on the mentorship platform. Zeus, how do you know that price is going to complete the market maker buy model or sell model if the logic is inverted? Well, if I see displacement through equilibrium of the range, it is already a very good sign to me because it confirms to me that the order flow is bullish and that price is likely to draw towards the opposite side of the range now. When bullish, we preferably want to buy either below equilibrium of the range, so in a discount, or we want to buy in close proximity to it. If we take a look at the schematic and we can see that every single retracement on the left side of the curve has been annotated. So for example, first retracement, you can see me mark up the low to high of that retracement and the middle of that price range. Second retracement, low to high and 50%, the middle point, low to high and again, middle point. You might be wondering, why would you annotate that? Because it's important to understand that the left side of the curve influences the right side of the curve. What I mean with that is the following. If the left side of the curve has retracements, the moment that price expands above a retracement that occurred on the left side of the curve, you do not want to see price get back below the low of that original retracement on the left side of the curve. So if we take a look at this first retracement on the right side of the curve right here and compare it to the left side of the curve, you can see the following. We can see that a retracement occurred from this low to this high. The moment that this high gets broken, we want to see This price range acts as support on price, and therefore I've annotated equilibrium of that price range again, because equilibrium, 50%, is a very important price level of any price range. So the moment that price retraces into that price range, into that box, so to say, my eye is drawn to whether or not it is going to act as support on price. And if it does, I'm anticipating price to expand higher. Into what? Into an old CB that formed inside this expansion leg. And here comes another gem. That CB that formed on the left side of the curve can function as a roadblock on price. So it means as an area where price will have a hard time getting through. This could mean that it will retrace after hitting that CB, or it could mean that it will distort time, so it will go sideways for a bit until the right time is present, and then it begins to expand, breaking through it. But let's say that it retraces from that CB. Let's say that after we have seen price expand higher, reaches a CB, we see it retrace. How deep can it retrace? Well, it can retrace to the high of the previous retracement on the left side of the curve. So let's say that within this cell model, this is the first retracement, second, third retracement. On the first stage of the market maker buy model, the low risk buy, price refers to the third retracement on the left side of the curve. For the next stage of the market maker buy model, the accumulation phase, price refers to the second retracement on the left side of the curve. And for the third stage of the market maker buy model, the second stage of accumulation, or what we call it, the silver bullet, price refers to the first retracement on the left side of the curve. And all these retracement legs on the left side of the curve need to act as support once broken in order to confirm that order flow remains bullish and that price is drawn towards the original consolidation. So you might be wondering, how can I open positions then? On demo accounts, of course. And what invalidates my idea if I'm anticipating higher prices? Well, there are 3 entry opportunities within a market maker buy model, and they are the following. The first entry opportunity, the low risk buy, occurs here. This low risk buy is the first retracement leg that occurs after order flow has shifted clearly, after the market displaced above this high, which is a bullish breaker. Market retraces into that, into a BC that formed during this price expansion / displacement leg, into this up close candle, into CBs that formed on the left side of the curve here. That's your low risk buy. Where do you place your stop loss? Well, if you want to be conservative, you place your stop loss all the way below this low. However, if you want to be more aggressive and you want to, so to say, be out when IBDA is not referring to the left side of the curve in a proper manner, which could be a sign of very choppy order flow, then you could place your stop below this candle's low right here. And we're cutting through candles. That means that we're looking at very specific price levels. We're not looking at candles and thinking, oh, candle got broken, therefore we don't refer to it anymore. No. We keep levels on our chart. And that's why the low of this retracement and the high of that retracement are important reference points on the right side of the curve. So to summarize, if you want to be aggressive, you enter here, place your stop below this candle's low right here, below the low of the retracement. And if you are conservative, you place it below this low right here that formed inside of your point of interest, because that low should not be violated, especially when there's SMT on the lows right here. The next entry opportunity is the following. When you have missed the low risk buy and price displaces to the upside, the next entry opportunity is a retracement into the high of that initial displacement leg and into the high of the second retracement leg on the left side of the curve. This usually gets paired with an upclose candle right here and with a BC that breaks through that upclose candle, making it true resistance turns support, or a bullish order block forms inside of this retracement leg. If you enter here, stop can be placed below this low, because again, if price expands above the second retracement on the left side of the curve, it should definitely not fall all the way lower if prices are going to draw towards the original consolidation's high. Because order flow has to be bullish by the discount raise inside of this expansion leg, acting as true support on price. And the final entry opportunity within a buy model is all the way up here. This is, in my opinion, the final opportunity before the range between entry to target, final target, is not worth it anymore. What we can see is that after the second entry opportunity, price expands above the first retracement leg on the left side of the curve, and it then retraces into the high of that retracement into imbalances that formed during this displacement leg, during this expansion. Entry here, stop loss here, boom, there it goes towards the buyer's liquidity above this high, and eventually higher if the higher time from order flow is bullish. So let's take a look at 3 live market maker buy model executions. So here we are at the first market maker buy model execution. What we can see is that price retraced into my point of interest, which was this candle's low right here, which was a higher time frame imbalance. I saw price displace to the upside above this upclose candle and above this series of downclose candles, these two, first downclose candle, second downclose candle, and I then entered long with a stop being below the low of the potential smart money reversal. My draw liquidity was above these relatively equal highs, because I understood that the higher time frame order flow was bullish. What we see is that in the displacement leg above this high, an imbalance formed, this BC right here. We then see price begin to expand away from that BC, which confirms that the order flow is bullish. That confirms that we have shifted from sell side delivery into buy side delivery. From there on, we are looking for every single downclose candle to act as support on price once broken. The reason why this candle's high should act as support once broken, resistance turns support, is because of the following. This candle's high formed inside this volume imbalance. Therefore, that volume imbalance should already act as support once broken. But secondly, the high that formed inside of the volume imbalance, inside of the gap, should also act as support, especially because it got broken right here by a bullish fair value gap, by a BC. And we see price begin to expand away from there, immediate rebalancing taking place right here into this candle's high. And my eye is drawn the whole time to the left side of the curve to see how it is influencing the right side of the curve. My eye is drawn to whether or not this CB is acting as support on price once broken. I do not want to see price displays below that CB anymore. Same was done here. And where could price find support next? You might be wondering. Well, the next area where price could find support is right here, inside of this CB. And look, we see a retracement leg. We see price expand, low forms, price retraces into that CB, it forms a high, then continues lower. Therefore, this upclose candle should act as support once broken. Here, price is distorting time, it's going sideways. What follows after consolidation? After consolidation, an expansion always follows. So when I see this, when I see price distorting time inside of an area where I'm anticipating price to find support, it's a beautiful sign. Again, resistance turns support. Why resistance turns support, you might be wondering. Because this candle's high got broken by a BC. Every retracement is being bought by smart money. So that means every single retracement leg that you see from this point all the way to point B, eventually, which is the drawn liquidity, is being bought by smart money. They buy, they buy, they buy, they buy, they buy. And that is what high frequency trading algorithms do. Every single retracement that occurs after change in the state of delivery formed, gets bought, and they pyramid their way to the drawn liquidity. Notice that what I said to you about this CB having to act as support on price, in fact, occurred, and notice that a BC broke through this candle's high. And their price reaches the drawn liquidity. Let's take a look at the second market maker buy model schematic or execution. Here we can see the second market maker buy model. What we can see is that this market maker buy model entry was later than the one showcased previously to you. The first real opportunity to enter within this market maker buy model schematic was down here inside of this BC. The reason why this was the first entry opportunity was because of the following. This big up close candle right here got broken through right here. Price retraces into that BC. However, because this so-called displacement leg was no real displacement, I prefer to wait until the second opportunity in order to confirm that order flow is bullish. Because look at how the market traded above these highs right here. Notice that it's very choppy. That by itself is not a very bullish sign just yet, in my opinion. When we then saw the market retrace into this BC and it acting as perfect support on price, my eye was drawn to whether or not price would continue higher, expand. Inside the expansion leg, there's a BC. Price retraced into that, and that was the entry opportunity. I believe I entered, a bit late, so a bit above the BC, but it doesn't matter because the room from point A, from entry to point B, the target, is still wide enough. Stop is below this low because this low should not be broken if price is in a buy program. Why? Because this low set up the expansion leg higher, the displacement above this high right here, and notice that on the left side of the curve, a CB formed here. So if you extend that CB to the right, you can see that a BC broke through that CB. Very important. Price trades back into the BC, but no worries because it has time to expand. I apologize about the quality not being the best inside this video. Sometimes Twitter recordings can be quite messy, and in this case it's the case unfortunately. Notice that relatively equal highs got engineered above here. Notice how choppy the left side of the curve was. So what is that signal? It's signal that when price begins to expand, it will be rather quickly. Eye is drawn to this down close candle, which should act as support once broken. Why should this down close candle act as support once broken? I'm going to give you a bit to think about that. Please pause the video if you are scared that you will not be able to think about it properly before I answer it. This down close candle right here is an inverted breaker. Therefore, mean threshold of that down close candle should function as support on price if price is going to continue higher. And there the big up close candles come. At this point already, your stop is already in my mind, or my stop is already in my mind at break even. Because I know that price should never fall back all the way to my entry anymore unless it's not going to reach my draw liquidity. Because it has broken through multiple areas that should act as support once broken. Annotating this candle's high to low, I could annotate this candle's low to high, but because this upclose candle formed inside the CB, I choose to only annotate that. And their price reaches the target. Notice that price never had to retrace back into this gap that got created here, and that is a signal of very bullish order flow. Okay, so here we are in the third example, and as I apologize. Let me just go back to the beginning of the video. As you can see, I entered inside of this up-close candle when price showed a willingness to find support inside of this BC. We purged relatively equal lows right here. We are trading below the 930 opening price. The higher time frame order flow is bullish, and therefore I'm anticipating this to be the low risk buy. Price begins to expand higher. Now I'm waiting for a new sign to confirm bullish order flow. Notice that when price closed above this down close candle, this big fat down close candle, the next candle opens up over sell side into the high of that down close candle, and it then immediately goes. That's a very bullish sign. Now price broke above this up close candle with a BC. But let's take a closer look at that up close candle. That up close candle formed inside of this CB. Therefore, this price level should act as support once broken. But more specifically, oh, it went back all the way to the beginning. I'm sorry. Technology sometimes. I'm going to leave this in. I'm not going to cut it out. Just enjoy the technical issues sometimes. Then you can see the delivery again. So now my eye is drawn to whether or not this BC. Why am I not allowed to watch my own video on Twitter? Let's view it like this. Surprise. Okay. I'm going to download the video and I will be back with you in a bit because it seems like for some reason Twitter is not allowing me to watch this video. I swear to God, they're doing some weird stuff with my Twitter lately. Must be random. Alright, I've downloaded the video and let me just fast forward it to where we were at when it stopped playing on Twitter. Price displays is above this opcoast candle right here. Now price should find support inside the BC that broke through that opcoast candle, but more specifically in the high of that candle. Price begins to expand without retracing into that opcoast candle. Why does that occur? Because on the lower time frames here, price already balanced out this opcoast candle's price range. So that means that in this big opcoast candle, on the lower time frames, price already retraced off its sell side and then shut up. Consolidation, time distortion, boom, there it goes. The moment that price broke above this opcoast candle, stop can already be drawn towards break even, or even better than break even, because price should never fall below this BC again if it's going to continue to be bullish. Price reaches this premium CB. And there it retraces. This is what I mean when I say that if price reaches a specific price range on the left side of the curve, which could for example be a CB, a premium CB, that CB could act as a roadblock on price before it's allowed to continue higher. The fact that price stopped right before reaching this buy side liquidity doesn't scare me. In fact, it makes me more bullish because I know what they're doing. They're engineering more buy side liquidity to attack at a later point in time. Price retraces, and here it retraces all the way into that opcoast candle that we were targeting initially for another entry for a pyramid. This retracement lag doesn't scare me because I understand that even though on the lower time frames this area is probably already balanced, on the 1 minute time frame it is still imbalanced and therefore we can anticipate price to retrace into it again. And as we can see, when price reached that red level, I pyramided because equal highs got engineered, cutting through candles, meaning that I want to see that BC act as support on price. Watch me annotate. As long as we stay above this low, we're in the buy program. What occurs? Price falls through that low, and therefore I wanted to be out at break even to reassess. Then what occurred was that price went all the way back to the entry and even below it. But notice that it did not display lower. In fact, you can see that the following occurred. We have relatively equal highs engineered up here. Price retraced into a deep discount. It fails to display lower. Therefore, I was looking for another opportunity to enter. I entered the moment that I saw that price was utilizing this yellow line as perfect support once broken. Price ran over this CB. So what we can see, by the way, is that if we ignore just the price action around this area and we purely look at the price action here, we can see that an original consolidation formed above these highs. Price begins to roll over, retrace, expand, retrace, expand aggressively into a point of interest for potential smart money reversal. And then we can see that bullish order flow occurs. And the reason why I'm sharing this example with you is because this is the reality of the markets. Not every single trading day will be as clean as I outlined during the previous two breakdowns. But notice how every single discount array that formed after price reached this level acted as perfect support on price, and their price reaches the target. Let's go back into the slideshow. Let us now take a look at the sell program, which occurs within bearish order flow. We are first going to take a look at a general schematic which you can utilize to gauge the order flow, and after that I will take you into some live executions and share how I view the order flow whilst the price is printing. So within a sell program, within a high time frame bearish order flow, we know that this is the market maker sell model that always is present. This occurs through the following lens. A original consolidation forms. Below that, sell side liquidity gets engineered. Market expands away from that original consolidation into a point of interest, into a deep premium of the current range during the right time, and it reverts. It reverses lower. The left side of the curve is filled with expansion, retracement, expansion, retracement, expansion, retracement. Final expansion, then a displacement leg occurs. So this is an expansion leg as well. Retracement, expansion, retracement, expansion, retracement, expansion. If we take a look at a more advanced version of the schematic, we can see the following. We can see that from the original consolidation to the high, we have drawn premium to discount. The reason why premium to discount is important is because if we are bearish and we are looking for shorts, we preferably want to go short inside of premium of this range. Meaning we want to short inside of the red area preferably, or in close proximity to equilibrium, which is 50%. The moment that price displaces below the range midpoint, below equilibrium, 50% of that range, we are anticipating the opposite side of the range, so in this case, the lower side of the range, to get reached. Notice that we have again outlined all of the retracement legs on the left side of the curve. Let's take a look at the first retracement leg. The first retracement leg occurred here. So what we have done is annotated the high to low of that retracement leg. The second retracement leg formed here. What we have done is annotated the high to low of that retracement leg. And then the third retracement leg occurred here, annotated the high to low of that retracement leg. Then finally the market displaced below that third retracement leg on the left side of the curve, which confirms a change in state of delivery. Sell program begins. From that moment on, every single retracement leg that occurs should retrace into a previous retracement leg's low on the left side of the curve. From there on, sell side delivery should occur. Important price levels on the left side of the curves are 50% of each retracement leg. The first entry opportunity to go short is the following. This opportunity is the low risk sell. This occurs after you have determined that the smart money reversal is in and price displaces lower. Inside the displacement leg, there will be a CB here that breaks through this low. This low preferably formed inside of a BC on the left side of the curve. Market structure shift pattern, first short opportunity here. Where do you place your stop loss? Well, if you're conservative, you place it above the high. If you're a bit more aggressive, you place it above the high of the retracement on the left side of the curve. Second entry opportunity is right here. This entry opportunity is an entry opportunity which forms when the market expands away after the initial entry opportunity and the market retraces into a CB that formed during that expansion leg into the low of that retracement which set up the initial entry opportunity. And the final entry opportunity is right here, and this occurs when price expands away from that second entry opportunity and the market retraces into a CB that formed inside the expansion leg, and it then continues lower towards the original consolidation. For both the second entry opportunity as the third entry opportunity, it's important to note that the stop gets placed above the previous high that forms. So where we said that inside of this entry opportunity, in the first one, we would place our stop either above the swing high right here or above the high of the retracement. For the second entry opportunity, it's the following. We place our stop above this candle's high. And for the third entry opportunity, we place it above this high. Because every time that price displaces lower, price should never return back above the high that set up the displacement or expansion leg. Therefore, that's how we manage our positions. Let us take a look at 3 live market maker sell model executions. So here we are on the first market maker sell model execution. What we can see is that price traded above this buy side liquidity here, which is the lunch buy side liquidity. Market consolidated above that, it distorted time and it then fell lower. Notice that price is respecting the CBs that formed inside of this displacement leg. Then price displaces lower again, new CB, price respects that CB perfectly. And then a new CB forms. Here, price retraces into that and price will seek to find resistance there and continue lower. Notice that I entered personally already when price displaced below the highest BC on the left side of the curve right here, because that should act as an inversion on price if price is going to be bearish. Next that, this BC should act as an inversion on price if price displaces below it. Price begins to roll over slowly. New CB forms here. Left side of the curve is influencing the right side of the curve. Notice that every single upclose candle inside of this leg lower from this high to eventually this low is acting as resistance on price. But when I say upclose candle, I do not just mean one upclose candle. This could also be a series of upclose candles. So for example, 1 or 2 or 3 upclose candles in a row that get broken through, and then you see the first upclose candle in that series get utilized as resistance from price. Original consolidation right here, relative weak lows engineered. Therefore, sell side liquidity is resting below those lows. And there the market expands towards the draw on liquidity. That is this market maker sell model completed. If we just take a look at the final delivery and we account for what was shared when it comes to position management, we can see the following. Every time that a high formed and the market displays to lower, we do not want to see price trade above that high, especially when these highs formed inside of CBs. And that is the general rule of thumb when it comes to position management. So even though I am not trailing my stop like a madman here, that is what I'm looking at. I'm looking whether or not the premium rays that are forming are acting as resistance on price. Because if they don't, if they fail to continue to act as resistance on price, it's a warning sign to me that something might change in the underlying order flow. But in this case, every single premium ray acted as perfect resistance on price, and therefore this was a nice market maker sell model to include within this lecture series. Here we can see the second market maker sell model example. What we can see is that the market reached a D premium. It respected a price level that I was looking for to be respected, a point of interest, perfectly. We then saw a displacement leg lower, right here, below this candle's low, breaking through this BC, here on the left side of the curve, and therefore this BC's price range should act as an inverse price range on price if price is going to roll over. Higher time frame order flow is bearish. We're anticipating lower prices on the higher time frames, and therefore this is the scenario we're looking for. We then see price retrace into this CB. It's very tiny, but the market retraces into that, and notice how the bodies are closing inside of that CB. The wicks are trading outside of it. They are mohawks, but the bodies are telling the story. The market then displaces lower and creates another CB here. The moment that price fell lower, again after trading into this CB, I waited and I shorted the retracement into this upclose candle, into that area. Stop was above this high, but in reality it could have already been above this high because price should have never gone above this high if it was inside of a bearish market. Now notice how I'm saying that this price range will be an inversion price range. This BC, this fair value gap, will function as an inversion value gap once broken. Because I understand that price is in a sell program on the higher time frame, and therefore all these discount arrays that are forming on the lower time frames on the M1 time frame that seem to be bullish arrays will be disrespected, and if they get disrespected, we will be looking for them to act as resistance once broken. Here you can see me monitor whether or not price will retrace into that inversion value gap. Wanted to see if that would occur because then I could pyramid there, but price reached my first partial, my first objective already before retracing. Then this BC should also act as an inversion once broken, but think back to what I outlined to you in the market maker buy model schematics. Whenever there's a BC, an imbalance in deep discount, right before the original consolidation, price could find, in this case, support there before it continues lower. And that's what we see here. Price taps into this BC and it doesn't straight break through it. Instead, it spends some time around this price range, which is time distortion. And once it begins to run, it will reprice quickly, is what you can see me right here. Notice that I'm not being fearful here, even though price is showing signs of potentially drawing higher. When the market showed these big upclose candles, I look at that as, oh, they're generating the idea right before my final target that a low is in. And so everyone tries to chase that. And here you can see that the market reaches the second target. And now you can see me aggressively manage the position because price went below this low, the reaction to this low signaled it all. And therefore I was looking for whether or not this BC would act as an inversion on price. What we see is that price goes above it, then finds support on it. So I knew that I would likely get stopped out on the remainder of the position. Because if price was going to trade lower, it would have just broken through this price level with speed and velocity instead of such a big mohawk wick, which seems like a sweep of sell side equity. And here we are in the third example of the market maker sell model executions. This was very quick from the entry because I entered inside of a retracement into this BC, this inversion value gap, and into the low of this candle right here. After I've seen that the confluences that have been shared thus far during this lecture were present, meaning SMT on the highs during the right time, displacement lag within a higher time frame, order flow which is bullish, but understand that in order to go higher on the higher time frames, we must first target sell side. We must first retrace into discount. So therefore, I was confident in that we were likely to draw towards sell side liquidity after purchasing the all-time high and seeing the signs that could confirm a reversal. Went short, wanted to see speed and velocity below this low right here. Partialed below this low. Notice that price is generating relatively equal lows right here. It's engineering, I must say. I'm not scared by this move higher right here and looking at that as, oh, this is displacement higher, market structure shift pattern, let's target these highs. No, because the higher time frame idea or analysis is always leading when it comes to determining where prices like to draw next. It's not just patterns for the sake of patterns. That's why you can see me say it's the engineering of sell side liquidity. And as long as price stays inside of the CB, I have nothing to worry about. One thing that is important to note is that if we take a closer look on the left side of the curve here for a moment, you can see me having annotated this candle's high right here. Why that candle's high? Well, that candle's high is the following. We saw an expansion leg, small expansion leg, but we saw an expansion leg, high form, low, higher high. This high acted as support on price right here. Look at the body's closing at it. Extend this price level to the right. Boom, perfect resistance on price. A gem I didn't share before because I didn't think I should share it, but here you go. And this is one of those things that many people do not see when they look at my executions, but it's just hidden in plain sight. And I would highly suggest you to investigate the logic shared during this lecture when it comes to the left side of the curve influencing the right side of the curve. My eye is drawn to these relatively equal lows. I look at all of this as time distortion, price waiting for the right time to come around, and then the market begins to expand lower. Price should now not come above this candle's high because this candle's high set up the expansion leg into the sell side liquidity below these lows. So therefore, if this high would get broken, it would be a potential bullish breaker formation. Target a premium of this range. But because there's no displacement leg that occurs above this high, no shift in order flow or change in state of delivery is present, and therefore order flow remains bearish. Final target is the London low. This red line is the low of the irregular trading hours gap, also a key price level. And the market begins to expand towards the price level. Now I'm monitoring the reaction of the price level because a crucial time has arrived. And when I saw that price respected the low of the regular trading hours perfectly, I decided to close my position. However, when the market retraced into this series of upgrowth candles right here, 1, 2, 3, and we saw displacement lower, below the regular trading hours, low, and below this downgrowth candle, I went short again because I was targeting the London sell side, and a bit below that. And we can see beautiful bearish order flow, immediate rebalance, breakaway gap. Why? Because this price range is already balanced. Therefore, price does not have to retrace since it's so bearish. Immediate rebalance again right here, and price reaches the target. So that's the third market maker sell model execution done. We're now going to take a look at key time windows for reversals and or expansions. I'm going to specify time more for you. I have given you certain time windows to look for smart money reversals already, but we're now going to take a look at more specific time windows to also confirm expansion legs. And the reason why I'm sharing these time windows with you is because when we're viewing price, we need to understand that if price is not expanding or showing a willingness to expand during these time windows, then the market is likely to chop around and consolidate. So we are learning here how to recognize whether or not a market is going to expand or consolidate. And this is a very important lesson to learn because it will separate you from the majority of traders out there that are caught off guard when the market basically showed signs of expanding initially away from entry, and then out of the sudden it fails to displace lower or displace higher, and it just consolidates and eventually falls back on your entry and maybe even takes you out for a loss. So let us take a look at the key time windows for the London session initially. The first key time window for London is from 2:45 to 3:15 a.m. And the reason why this time window is important is because of, first of all, it's within the general time window that has been shared with you for the London session. But secondly, it's around the 3 a.m. opening. 15 minutes in advance of the 3 a.m. opening and 15 minutes after the 3 a.m. opening. And what you will often see is that if London is going to present nice market maker model opportunities, then a SMR, smart money reversal, has either occurred already from 2:30 and from 2:45 it begins to expand, or the SMR forms during this time window and after that it shows a willingness to expand. The second time window for London is from 3:45 a.m. to 4:15. If during these two time windows the market is not showing speed and velocity being injected into the marketplace, then that's a sign to get the F out. And it means to focus on the next opportunity. Because if there are no signs present of an expansion occurring after the smart money reversal is confirmed, then we can anticipate very choppy delivery to occur. If we take a look at the morning session, the first key time window for the morning session is from 9:45 to 10:15. Between 9:45 and 10:15, we want to see either a smart money reversal form if it's not in already, or we want to see the market begin to show signs of willing to expand into our anticipated direction. If this does not occur, it will likely occur during the next time window, which is from 10:45 to 11:15. If the market did not show any signs to begin to move, meaning that volatility got injected into the marketplace during that first time window, then we can anticipate the second time window to be utilized for this. With regards to environment selection, this also plays a huge role with detecting which time window is likely to be utilized for the expansion or the beginning of the expansion of that session. Because if we take a look at the 9:45 to 10:15 window, if, for example, there's a, let's say, a very choppy session, very choppy opening range, then the market is likely to chop around all the way into 10:30. So engineer liquidity on both sides of the marketplace for at least an hour, and then manipulate to one side of the marketplace, trap people into believing that's gonna go one way, and then from 10:45 or around 10:45, a low or high will form, and the market will begin to expand outside of that range. Just one simple example, but please refer to the opening schematics that have been shared during previous lectures with regards to how we can apply the opening ranges. Because if we understand that during these time windows, specific things should occur, meaning that we should see displacement legs occur, and the market begin to expand into a one-sided direction, then this will give us very time-based opportunities, but also very time-based opportunities to manage our positions. Because if the market is not showing a willingness to continue to expand during these time windows, or at least begin an expansion during these time windows, then it's a warning sign. That means, okay, we might be wrong with our whole thesis for now, and therefore we might need to cut our trades. For the afternoon session, the first time window is from 1:45 to 2:15 p.m. and the second time window is from 1:45 to 3:15 p.m. What you'll often see is that if that first given time window forms a smart money reversal, the market will expand all the way to 2:45, and if it reaches the draw on liquidity by then, it's possible that the daily retracement will form from the second time window for the afternoon session. If the higher time frame objective, if the daily draw, so to say, the daily predetermined price level where the higher low will form, has not been reached yet before 2:45, then the market is likely to continue to expand to that price level during this time window. These are very rule-based time and price models that I am teaching you. And if you're not paying close attention to the words utilized to share this with you, you are likely to miss out. And that's why you can't treat this series like a Netflix series, where you just go through everything, don't take proper notes, don't go into your own charts, because then you will not see the real value in what is being shared. I know that some people look at this and think, oh, okay, nice to know. And then next week they just go into the charts, into the live charts, and they say, oh, because he said so, it should work this way. Instead of going into their own charts and see whether or not there's any validity behind the things that I'm sharing with you. Don't be lazy. Don't be lazy, because by simply watching these lectures, it will not be enough to make you understand it. If we take a look at the next schematic, we are going to look at the following. Here we can see the schematic again from the buy program that was outlined before. For the buy program, there are 3 opportunities too long. Our eye is drawn to whether or not the buy program will begin between 2:45 to 3:15. If the smart money reversal occurs prior to that, so between 2:30 to 2:45, then we are looking for this 30-minute window to expand price. So to show a willingness to continue higher. If we are taking a look at the next time window for the London session, we can see the following. We can see that we are looking for a smart money reversal to form between 3:45 to 4:15 a.m. if it did not form just yet. And if it did not form yet, then this is the final chance for a smart money reversal to form. But I would say even that the smart money reversal should have already formed by 4 a.m. if one is going to form at all during the London session. This time window should be utilized for expansions. For the AM session, the time window of interest where a smart money reversal should form preferably, or at least signs of an expansion if a smart money reversal already occurred between 9:30 to 9:45. The signs of an expansion should be present between 9:45 to 10:15 a.m. By the way, if you are not taking screenshots thus far of these schematics, you are missing out. Don't be lazy, take screenshots of each schematic, and then when the delivery occurs, which it will occur, you will be able to refer back to those screenshots, back to these schematics, and you will see that there's a certain repeating phenomena that occurs during these time windows. So if the smart money reversal occurs right after 9:30, so before 9:45, 9:45 will not form the low. Instead, it will likely continue the trend of that smart money reversal. For 10:45 to 11:15, this is what the schematic looks like. This occurs when from 9:30 to 10:30 the market was messing around, chopping around, maybe generating the idea that we were going lower but not delivering aggressively lower. Instead, the market reaches a higher time frame POI between this time window, and then it shows a willingness to reverse, and then from there on we can see buy side delivery occur next. Notice that it is not a preferred scenario because it's of course outside of the initial time window given from 9:30 to 10:30, but this is an additional time that we can look at if specific criteria have been met. The main criteria to look out for is the following. How is the opening range being formed? After the first 30 minutes, you already know whether or not a smart money reversal is going to form anytime soon. If the answer to that question is no, then we will anticipate a smart money reversal followed by an expansion to form later down the AM session, and that is when this time window plays a key role. If we take a look at the PM session, you can see that for the PM session, the key time window is of course 1:30 p.m. to 2:30 p.m. If a smart money reversal occurs between 1:30 to 1:45 p.m., then the time window annotated here will of course not form the low of the market maker buy model. If that occurs, we want to see that time window here expand price, so inject volatility during this time window. If a smart money reversal did not occur between 1:30 to 1:45 p.m., then we are looking to see whether or not it will form between 1:45 to 2:15 p.m. If the smart money reversal does not occur within these time windows, our eye is drawn to the next window, which is 1:45 to 3:15. If a smart money reversal occurs between 2:30 to 2:45 p.m., then we are anticipating the market to expand between 2:45 to 3:15 p.m. If the market did not form a smart money reversal between 2:30 to 2:45 p.m., then we are looking for a smart money reversal to occur between 2:45 p.m. to 3:15. Again, this occurs when that initial time of interest between 1:30 to 2:30 p.m. does not show a willingness to form a smart money reversal and expand price. Then our focus is on the third 90-minute window of the PM session, meaning from 2:30 to 4 p.m. to see whether or not any opportunities will present themselves. However, it's important to note that I suggest you to only focus at one time window, and that time window is a time window shared during the time lecture. For the people that are more advanced and want to do more, these are the extra times that they can add to their protocols. For the cell programs, the logic is of course inverted, and therefore please take screenshots of the following schematics so that you have them within your notes. Here is the second London time window where a reversal or expansion leg should occur during. Here's the first time window for the AM session where a reversal or expansion should occur during. Again, please take a screenshot please of these schematics so that you can study them at a later point in time without having to go back to the video. And here's the second time window for the AM session that is of relevance when it comes to detecting a potential reversal and or expansion leg. For the PM session, here's the schematic for the first PM session's time window where we are looking for a reversal or expansion to originate from. And here's the second time window for the PM session where we are looking for signs of a reversal and or expansion to originate from. So to summarize this lecture and to summarize basically the protocol that has been shared thus far with you, we can see that we come to the following rules. First of all, we must know the higher time frame order flow. We must determine the drawn liquidity, which comes as a result of determining A to B, where is price likely to draw towards next. From there on, we have our times of interest for all the sessions. They have become even clearer after today's lecture. We have our point of interest. We are looking for this point of interest to be reached during our time of interest. We will then look for SMT, a cracking correlation with highly correlated markets or inversely correlated markets, of course. And we will look for change in state of delivery, meaning a market structure shift or a willingness of the market to displace into the opposing direction of what the order flow was thus far until reaching the point of interest. We will then look for an entry opportunity, and once we have entered, we will feel order flow. Is order flow confirming your thesis whilst being in the position? This is trade management. This lecture was pretty comprehensive. There was a lot of topics that were discussed. I hope that you were able to listen to it properly, that you are not basically experiencing a headache, so to say, of all the information shared. If this is the case, good stuff, because you have learned new things then. And I would advise you to go back to this lecture at a later point in time when you feel like you need to pick up on new stuff or need to pick up on specific topics shared during this lecture. This is a lecture that showcased that there's way more to the market maker models than it seems simply on the surface. And this was the first real lecture in which I shared additional gems to what has already been shared. I'm excited for the next lecture because during next week's lecture, we're going to take a look at the following topic. We have discussed so far the technical side of things. We have discussed what things we are looking for when it comes to technical analysis. We're now going to take a look at environment selection because we will only look for these things inside of the markets during specific environments. So that is what next week's lecture is going to be about. Environment selection. When do we look for these things then? Okay, it's nice that we understand it now, but when should I look for it? And when shouldn't I it? When doesn't it work? So that is going to be a very exciting lecture because it's going to be all about planning and seeing it in advance when the probabilities or the odds are in our favor. I want to thank you for watching this lecture and I wish you a nice day. I look forward to speaking with you soon.